Welcome back. This morning, we woke up to a double whammy of negative news. One, the continuous decline in U.S. markets with the key indices Wall Street declining for 4 consecutive days. And then we had the weak macro print. The Q1 GDP numbers for India missed street expectations, coming in at 13.1%. That said, after a weak start, markets have managed to recover about 150 points from the day's low. And as we speak, we're sitting with a modest cut of about 0.5%, and the mid-cap index is in the green. But let's focus on that Q1 GDP print, which at 13.5% is lower than economists' expectations. Latha is here to give us the fine print. Latha?
Well, first the numbers, GDP first quarter number came in at 13.5%. The CNBC-TV18 poll, or the street estimate, was between 15 and 15.5%. And the Reserve Bank's projection was 16.2, so it's lower than all that. Now, if you adjust this number to the Reserve Bank's projections, then the Reserve Bank's full year forecast falls from 7.2% arithmetically to 6.7%. Now, let me just explain why this 13.5 is a bad number. At the outset, 13.5 GDP growth over 20% last year looks good. I'll tell you why it's weak. If you take the actual Q1 GDP, it is 36.85 lakh crore. And this is only 3.8% higher than 3 years ago GDP of FY20. That's a poor record of growth. The weak elements are first construction. Construction GDP has come in at 2.62 lakh crore. That's the latest quarter, which is a good 16.8% higher than last year. But it is only 1% higher than the 3-year-ago level. That is the decline in consumption. Likewise, another huge category, trade, hotels, transport and communication. It's a large segment. Now, there the GDP is 5.59 lakh crore in the latest quarter. A good 26% higher than last year, but 15% lower than what it was 3 years ago. And both these sectors are, large employers. They comprise, the small Udupi hotels, traders, medium and small enterprises, unorganized labor in construction. Now, that is the weak part. What are the strong points of the GDP? Private consumption. Private final consumption expenditure has come in at 22 lakh crore, which is 26% higher than last year. And over the 3-year level, it's a decent 10% higher, which is over a 3% compounded growth. Likewise, capital formation. Capital formation has come in at 12.8 lakh crore, which is 20% higher than last year, but a decent 6.7% higher than the 3-year-ago level. Not spectacular, but at least it's not bad. Now, following the weaker than expected Q1 headline number, many brokerages have cut their full year estimates, mostly to around 7 or below 7. Citi is the most important. They have cut their real GDP number to 6.7. They were standing at 8, so that's a huge cut. JP Morgan has merely said that they are standing at around 7%. So it's not above 7. Morgan Stanley has cut it from 7.6, where they were, to 7.2, so a 40 basis point cut. And CLSA was sitting at 6.7. They have upped it to 6.8%. But the short point is there is a very good possibility India will not get to 7% growth this year. It may be a 6 handle, maybe 6.8, 6.9.
Okay, thank you very much.